topic examines liquidity and funding risks within alternative investments and leveraged portfolios. Liquidity risk refers to the inability to sell assets quickly without materially affecting market prices, while funding risk involves the inability to meet cash obligations, such as margin calls or collateral requirements. The topic emphasizes that these risks become particularly severe during market stress, when leverage, declining asset values, and reduced market liquidity interact simultaneously. Alternative investments are especially vulnerable because many strategies depend on leverage, derivatives, and illiquid securities. Effective risk management, therefore, requires understanding collateral mechanics, stress testing liquidity demands, and preparing for extreme but plausible funding disruptions during adverse market environments. A major topic within the topic is margin accounts and collateral management in futures and managed futures portfolios. Commodity trading advisors, CTAs, frequently use leverage derivatives that require only a fraction of total exposure to be posted as collateral. The program defines three important measures: trading level, funding level, and notional funding. Trading level represents the total capital exposure used to calculate returns and fees, while funding level refers to the actual cash or collateral posted by the investor. Notional funding reflects additional leverage exposure beyond deposited capital. Because leverage amplifies both gains and losses, investors must carefully monitor collateral sufficiency and maintain liquidity reserves capable of supporting margin calls during periods of heightened volatility and market stress. The topic also explains how value at risk (VAR) is used to estimate potential losses and funding requirements within managed futures portfolios. VAR measures the expected maximum portfolio loss over a specified time horizon and confidence interval under normal market conditions. Although VAR is widely used for risk management, the program notes important limitations, particularly during extreme tail events when historical relationships and volatility assumptions may fail. Investors must therefore complement VAR analysis with stress testing and scenario analysis that examine severe but plausible market shocks. The program also discusses the omega ratio and other approaches used to estimate liquidity needs by evaluating downside risks, return distributions, and the probability of extreme funding pressures arising during adverse market conditions. Another major focus of the topic involves smooth returns in illiquid investments, such as private equity and real estate. Illiquid assets are often valued infrequently using appraisals or model-based estimates rather than observable market transactions. This process can artificially reduce measured volatility and correlation, creating the appearance of more stable performance than actually exists. The program explains that return smoothing may arise intentionally or unintentionally through valuation practices that lag changing market conditions. Smoothed returns can therefore distort performance evaluation, underestimate portfolio risk, and weaken diversification analysis. Investors relying solely on reported returns may incorrectly conclude that illiquid assets carry lower risk and stronger diversification benefits than their true economic exposures would suggest. The program further examines model price smoothing and the process of unsmoothing return series to better estimate underlying economic risk. Unsmoothing attempts to adjust reported returns by removing artificial serial correlation caused by appraisal-based or model-based valuations. The topic explains that unsmoothed data generally exhibit higher volatility, greater correlation with public markets, and more realistic downside risk characteristics than smooth datasets. Real estate return data provide an important example because appraisal-based indices often lag transaction-based price changes. Unsmoothing techniques therefore help investors more accurately assess portfolio risk, expected drawdowns, and diversification properties. Accurate risk estimation is particularly important for institutional investors allocating large portions of portfolios to illiquid alternative investments with infrequent valuation updates. The topic concludes by emphasizing the importance of integrating liquidity and funding risk management into broader portfolio oversight processes. Liquidity crises frequently emerge when leverage, concentrated positions, declining asset values, and margin calls interact simultaneously under stressed market conditions. Investors must therefore evaluate both asset liquidity and liability liquidity rather than focusing exclusively on expected returns. Effective practices include maintaining liquidity buffers, conducting stress tests, diversifying funding sources, and monitoring collateral requirements across counterparties and clearinghouses. The program also stresses that illiquidity premiums should not be viewed as free returns because they compensate investors for accepting substantial funding and market risks during periods of financial disruption. Strong liquidity management ultimately supports portfolio resilience, operational stability, and long-term investment sustainability.